Avanza Bank Holding AB (pub) represents a leading example of a highly efficient, digitally native financial institution operating within the Swedish savings market. The analysis confirms a structurally sound business model characterized by exceptional profitability and robust capitalization, which fundamentally justifies the company's premium market valuation. The financial performance in the third quarter of 2025, Q3 2025, underscored the resilience and operational gearing of the platform. Operating income increased substantially, rising 19% year-over-year to SEK 1,142 million. This surge in revenue, driven primarily by higher net brokerage and net currency-related income, flowed through efficiently due to effective cost control, resulting in a 24% increase in operating profit, reaching SEK 818 million, which matched a previous single-quarter record. The resultant operating margin stood at an impressive 72%, contributing to an annualized return on shareholders' equity (ROE) of 45% for the period, confirming Avanza's status as an elite performer in capital utilization. The core investment thesis is predicated upon three fundamental pillars. First, the proven ability of the capital-light business model to sustain an industry-leading return on equity, with a long-term management target set at a minimum of 35% annually. Second, the immense strength of its regulatory capital buffers, evidenced by a Common Equity Tier 1 (CET1) ratio of 26.9%. Third, the consistency of its capital return policy, which is aggressively managed through a high earnings payout ratio, but is demonstrably safe when assessed against the company's robust free cash flow (FCF). While the operational profile is superior, the market pricing is aggressive. The stock trades in line with the broader industry price-to-earnings (PE) average, specifically around 21.6x, compared to the Swedish capital markets industry average of 21.7x. Material risks to the thesis include external regulatory friction, such as the Riksbank's new deposit requirement, which is projected to result in a loss of SEK 225 million in annualized interest income, and mounting competition from Nordnet, which benefits from a total addressable market 3 times larger than Avanza's Sweden-only focus. The current consensus analyst rating is buy, derived from a breakdown of 4 buy recommendations, 5 hold, and 1 sell among 10 covering analysts. However, the average 12-month price target suggests limited immediate capital appreciation potential, with an implied upside of only 3.37% based on current market levels. Deep dive into cash flow dynamics and operating resilience. A. Structural characteristics of fintech banking cash flow. A rigorous analysis of Avanza's cash flow requires acknowledging the fundamental differences between a brokerage bank and a traditional commercial bank or an industrial enterprise. As a fintech bank and primary retail custodian, Avanza's cash flow from operations (OCF) is intrinsically dominated by the administrative movement of customer funds. This movement relates to fluctuations in the balance sheet components designated for customer management, which includes liquidity provisions and internal treasury operations. This structure explains the inherent and historical volatility observed in the reported OCF figures. For a financial institution of this type, large swings in OCF are not unusual, reflecting substantial positive and negative movements in assets and liabilities related to customer transactions and treasury management. For instance, a period of net customer cash withdrawals or a strategic reduction in short-term investments, such as treasury bills eligible for refinancing, would be registered as a positive contribution to the change in net operating assets line, thereby inflating reported OCF. Conversely, a massive inflow of customer savings waiting to be invested would temporarily depress OCF. Consequently, OCF for Avanza is interpreted less as an indicator of immediate core profitability and more as a reflection of net customer liquidity flows and internal treasury deployment decisions. Investors must therefore avoid the pitfall of applying standard OCF metrics typically used for manufacturing or capital-intensive sectors. The true quality of earnings is instead affirmed by the consistent, high conversion of revenue into profit before treasury adjustments, demonstrated by a robust trailing 12 months TTM net profit margin of 54.29% and the exceptional Q3 2025 operating efficiency. The structural volatility of OCF is thus understood as a natural, low-risk feature of managing customer liquidity, not a sign of fundamental operational stress. B. Analysis of Q3 2025 income mix and resilience. The Q3 2025 performance, achieving a record-matching operating result, illustrates the success of Avanza's diversified multiple revenue stream business model. Operating income for the 9-month period increased by 18% year-over-year. The acceleration in income streams was predominantly driven by transactional activities, suggesting favorable market sentiment that spurred retail investment activity. Net brokerage income experienced a robust 35% increase year-over-year, while net currency-related income saw explosive growth of 66% year-over-year. Within this category, FX income alone jumped 34% sequentially compared to Q2 2025, confirming renewed and robust customer interest in foreign trading. Net fund commissions and net interest income also increased, showcasing strength across the entire revenue stack. Crucially, this substantial revenue growth was managed with high cost control. Operating expenses increased by a comparatively modest 8% year-over-year. Moreover, operating costs were seasonally low in Q3, decreasing by 8% compared to Q2. This combination of revenue acceleration and controlled spending drove the exceptional operating profit of SAK 818 million and propelled the operating margin to 72% for the quarter. C. Sensitivity to interest rate environment and net interest income, NII management. Avanza's net interest income, NII, remains a healthy component of the income mix, demonstrating resilience even in the face of downward pressure on market rates. Management has actively addressed the shifting interest rate landscape, specifically following Riksbank policy rate cuts in late June and early October 2025. On the asset side, the mortgage rate tracks the policy rate directly. Furthermore, Avanza proactively cut the margin lending rate by 34 basis points. However, the impact of the lower rate was largely mitigated by concurrent higher lending volumes, and the average rate for internally financed lending saw only a modest decrease from 3.27% to 3.01%. On the liability side, which relates to interest costs on deposits, the average annualized deposit rate decreased from 90 to 80 basis points, achieved by reducing savings account rates despite growing deposit volumes. Following the Riksbank September announcement of another 25 basis point cut, Avanza implemented a 20 basis point cut to its savings account rate. This measured response, which did not fully pass through the policy rate reduction, was a strategic decision intended to maintain a competitive position as the bank phases out collaboration with external savings accounts partners. The full effect of these Riksbank rate cuts on NII is subject to a temporal delay because Avanza manages its surplus liquidity by maintaining up to 3 months interest rate duration in its bond portfolio. This tactic implies that the full financial pressure on NII arising from rate normalization will likely become more pronounced in the subsequent quarters of late 2025 and early 2026. This dependence on NII stability is mitigated by the strong revenue diversification. The rapid expansion of transactional income streams, brokerage, foreign exchange, and fund commissions acts as a robust operational hedge against any secular decline in NII caused by policy rate normalization. The strong trading environment in Q3 suggests that renewed market confidence and the resultant shift of customer funds out of pure cash savings, which were very high in Q2, and back into tradable assets can successfully stabilize and grow total revenues, insulating the firm from modest NII compression. Furthermore, while operational expenses were generally controlled in Q3, management has guided for an 11% overall cost increase for the full year 2025. This investment cycle is necessary and strategically focused on reinforcing core areas such as pensions, private banking, and the ongoing cloud migration. Such accelerated spending is critical for maintaining the company's long-term competitive advantage, particularly its cost-to-income ratio, and achieving the targeted long-term cost growth ceiling of 8% per year by 2030. The company's exceptional current profitability, 45% Q3 ROE, provides the financial latitude to comfortably absorb this temporary spike in operational spending, reinforcing the structural strength of the business model. 3. Balance sheet stability and capital adequacy. A. Capital adequacy assessment, CET1 and risk-based requirements. Avanza's capitalization profile is characterized by an extremely high degree of strength and security. The Common Equity Tier 1 (CET1) ratio, a key measure of a bank's financial strength, stood at an industry-leading 26.9% as of Q3 2025. This substantial figure provides a massive capital buffer against regulatory minimums and unanticipated losses. Moreover, the Swedish Financial Supervisory Authority, FSA, formally acknowledged the bank's low-risk profile through the Supervisory Review and Evaluation Process, SREP, announced in September 2025. The risk-based Pillar 2 requirement, P2R, was reduced from 5.71% to 5.02%. This resulted in a corresponding decrease in the total risk-based capital requirement, which moved from 18.21% to 17.52%. The regulatory reduction underscores the low intrinsic risk associated with Avanza's asset portfolio, which consists predominantly of highly liquid, low-risk brokerage assets and custody holdings. B. The governing constraint, leverage ratio analysis, and customer inflows. Despite the substantial headroom afforded by the high risk-based capital metrics, the analysis confirms that the regulatory leverage ratio requirement remains the governing constraint on Avanza's balance sheet expansion. The total required leverage ratio is set at 3.5%, which incorporates a Pillar 2 guidance, P2G, of 0.5%. The dynamic growth inherent in Avanza's successful business model creates a structural tension against this regulatory metric. Net inflows remain substantial, with savings capital increasing by 14% to SEK 1,054 billion by the end of Q3 2025. Strong deposit inflows increase the balance sheet denominator, total assets, rapidly. Since the capital base, equity, must grow proportionately with assets to maintain the leverage ratio, excessive asset growth without commensurate earnings retention or equity raises can quickly constrain the bank's capital flexibility, potentially limiting both dividend capacity and organic asset deployment. The high CET1 ratio, exceeding 26%, confirms that Avanza has vast theoretical capacity to absorb credit or market losses. The constraint, therefore, is not risk-based, but size-based. The management of non-risk assets, particularly the efficient deployment of customer cash into capital-efficient, secured lending products, such as mortgages, that maximize NII while optimizing the balance sheet, becomes the crucial determinant of future capital strategy. C. Regulatory headwinds, quantifying the Riksbank deposit requirement impact. A specific quantifiable regulatory friction was introduced by the Riksbank, mandating that all banks deposit a portion of their deposit base at a 0% interest rate effective October 31, 2025. This measure creates a concrete headwind for net interest income. For Avanza, this requirement translates to SEK 225 million that must be deposited and is explicitly reported by management as a loss of interest income, categorized as an interest expense. This measure acts as an unavoidable structural cost, effectively placing a tax on successful deposit growth by reducing the marginal return on incremental cash inflows. To contextualize this impact, the Q3 2025 profit for the period was SEK 699 million. The annualized cost of 225 million thus represents a non-trivial drag on future profitability that must be overcome through superior operational efficiency and growth in non-interest-related revenue streams. This friction makes the management of capital allocation even more critical, as aggressive competition for deposits is immediately penalized by the mandated 0% interest placement. 4. Dividend safety and capital allocation sustainability. A. Dividend policy adherence and deviation. Avanza's official long-term policy targets the distribution of 70% of annual profit to shareholders. Historically, however, the company has frequently demonstrated a willingness to exceed this stated policy, reflecting high confidence in the quality and predictability of its earnings streams. The proposed cash dividend per share for 2024 was SAK 11.75, which represents a slight increase from the SAK 11.50 distributed the previous year. This proposed dividend corresponds to a payout ratio of 82% against earnings. Other trailing 12 months calculations place the ratio between 70.66% and 87.19%. While high, the consistent approval of payouts exceeding the 70% target signals a deep management conviction in the durable financial health of the bank and the ample distance maintained above regulatory capital requirements. B. Earnings versus cash flow payout ratios, a critical distinction for sustainability. The perceived risk associated with a high earnings payout ratio, around 82%, is substantially mitigated when scrutinizing the dividend coverage against true operational cash flow. This distinction is critical for evaluating the long-term sustainability of the capital return program. The free cash flow payout ratio is reported to be substantially lower, at approximately 47%. This major discrepancy between the high reported earnings payout ratio and the conservative FCF payout ratio confirms Avanza's superior operational cash conversion capabilities. The dividend is therefore strongly covered by actual cash generated from operations, rather than relying solely on statutory net income figures, which may include non-cash accounting adjustments. This provides a robust margin of safety, assuring investors that ample capital is generated for reinvestment despite the aggressive shareholder returns. C. Coverage reliability and historical growth context. The dividend sustainability is backed by formidable underlying profitability trends. Avanza has achieved an outstanding 5-year average earnings per share growth rate of 37.27%. Near-term analyst forecasts project a continued expansion, with EPS expected to grow by 25.6% over the next year. If this projected growth trajectory is maintained, the earnings payout ratio is naturally expected to normalize towards or slightly above the official 70% policy, reducing the perceived strain associated with the current high levels. The practice of returning surplus capital via a high yet FCF-covered dividend is also a strategic capital management tool. Given that the leverage ratio remains the binding regulatory constraint, distributing excess capital through dividends is a highly efficient mechanism. This prevents unnecessary equity from accumulating on the balance sheet, which would otherwise increase the denominator of the leverage ratio, total assets, and potentially constrain future high-return asset growth. The high dividend acts as a strategic release valve to optimize the capital structure. Furthermore, the simultaneous commitment to both a generous dividend, SAK 11.75, and substantial operational reinvestment, including the guided 11% cost increase for technology initiatives, demonstrates management's powerful conviction that the platform's high margins and scalability are sufficient to support both initiatives fully, reinforcing the outlook for earnings visibility and structural competitive advantage. 5. Valuation framework and relative positioning. A. Absolute valuation metrics, PE, PB, and the role of high ROE. Avanza's market valuation reflects its status as a high-growth, high-quality financial technology platform. The trailing 12 months, TTM, price-to-earnings ratio currently ranges between 21.6x and 22.05x. This places Avanza's PE multiple approximately in line with the Swedish capital markets industry average of 21.7x. However, the more striking valuation metric is the price-to-book ratio, which is approximately 8.92x. This metric implies that the market is willing to pay almost 9 times the reported book value of equity per share. This significant premium is not arbitrary. It is fundamentally justified by the company's sustained industry-leading return on equity. Avanza's TTM ROE stands at 40.45%, having achieved an annualized 45% in Q3 2025. A financial institution that can consistently generate such superior returns on capital, far exceeding the median ROE of 6.6% for the broader financial sector, commands and warrants a substantially higher PB multiple.
B. Peer comparison and competitive dynamics. Avanza versus Nordnet. A key benchmark for Avanza is its primary domestic and Nordic competitor, Nordnet. In a relative valuation comparison, Avanza's PE multiple, 21.6x, is slightly below that of Nordnet, 23.2x, 7, despite Avanza posting a marginally higher or equivalent ROE. This modest premium assigned to Nordnet can be rationally attributed to its structurally larger total addressable market, TAM. Nordnet's operations span the entire Nordic region, giving it a market opportunity estimated to be 3 times larger than Avanza's domestic Sweden-only focus. For international investors, this wider geographic diversification often translates to superior long-term growth scalability and reduced single-market regulatory risk. Operationally, both companies operate on highly desirable capital-light business models that drive extreme returns on equity. 4. Analysts have noted that Nordnet has been highly successful in closing the historical gap in operational efficiency and profitability with Avanza, particularly following significant IT investments during its unlisted phase. 4. Consequently, while Avanza currently exhibits best-in-class efficiency, the competitive landscape is intensifying, challenging the longevity of its historical dominance. C. Analyst consensus, price target implications, and growth premium justification. The current consensus among covering financial analysts is generally positive, with a buy rating based on the insights of 10 analysts. The supportive view reflects confidence in the company's durable profitability and strong growth history, 5-year EPS growth averaging 37.27%. However, this optimism is tempered by the average 12-month price target, which stands at SAK 374. Relative to the current trading price, this suggests a very limited potential capital appreciation of only 3.37%. This discrepancy, a buy consensus alongside negligible expected price upside, strongly suggests that the market has already factored in Avanza's high growth trajectory and structural quality. The valuation offers minimal margin of safety. Given the already lofty PB multiple, near 8.9x, the stock is highly sensitive to any factors that might suggest mean reversion in its elite profitability. Any deceleration in achieving the 15% average annual savings capital growth target, 3, or sustained earnings pressure from the regulatory NII drag, 2, could trigger a rapid derating of the PE and PB multiples. Therefore, the investment rationale shifts away from seeking short-term capital gains toward owning a high-quality, high-yield compounder that prioritizes stable, exceptional returns on capital and consistent dividend payments, yield approximately 3.23%. V. Conclusion. Avanza Bank Holding AB, public, presents a compelling financial profile rooted in operational supremacy and regulatory conservatism. The core operational quality, highlighted by the Q3 2025 operating margin of 72% and the 45% quarterly ROE, is undisputed, confirming the highly scalable and capital-light nature of its digital banking platform. Balance sheet stability is guaranteed by extraordinary capital reserves, particularly the 26.9% CET ratio. However, the analysis identifies the regulatory leverage ratio, 3.5%, as the practical limit to asset growth, necessitating careful management of customer deposit flows. Furthermore, regulatory intervention, specifically the SEK 225 million annualized cost from the Riksbank deposit requirement, represents a tangible and ongoing friction against net interest income growth, requiring superior performance from transactional revenue to maintain total revenue momentum. Dividend safety is robust, resting not on the already high 82% earnings payout ratio, but on the conservative 47% payout ratio relative to free cash flow. This discrepancy confirms high-quality cash conversion and underscores that the dividend is structurally sustainable and serves as an important tool for capital efficiency under the prevailing leverage ratio constraint. Therefore, the investment rationale shifts away from seeking short-term capital gains toward owning a high-quality, high-yield compounder that prioritizes stable, exceptional returns on capital and consistent dividend payments, yield approximately 3.23%.